Hey guys, how's it going? Welcome to phase three. Welcome to phase three of the harmonics trading plan. If you guys are on this video, it's because you guys have already went through phase one and phase two. You guys already understand how to look for divergence. You guys already understand the time zones for these sessions, right? You guys understand how to use a 20, 30 pip stop loss, right? So now in phase three, what we're going to go over is blending institutional concept, guys. That is taking order blocks, that is taking highs, lows, fair value gaps, breakers, mitigation, all of these things in institutional knowledge. We're going to start blending them in with the harmonic scanner, guys. All right. So go ahead and start off with something pretty simple. Let's see. Let's pick one of these pairs, see one of the winning ones. NZD USD on the 1 hour time frame. All right, guys. So first, go ahead and take away everything here. By taking it away, all you have to do is go down here to hide everything. So for everybody who understands what an order block is, guys, you guys can obviously tell that we hit a bullish order block right here, guys. Right, this is a bullish order block right here. So if we turn on our harmonic scanner, our D entry point is touching on a bullish order block. This is a great indication as institutional traders that we could see some bullish price action, right? Now, on top of that, guys, on top of this being a bullish order block, we also do have a fair value gap from here to right here. Go ahead and change that color, we'll make it red. Right, and we notice that we take this across. If we take this box across, price comes and fills that up. Price comes right down and fills that up. So this is a high probability setup, guys. So now NZD USD by the harmonic scanner is giving you confirmation now that we could see a nice potential buy. Although, guys, we do not see divergence, right? Although we do not see divergence on this pair, right? We're making lower lows, but here on the RSI, we're also making lower lows, right? We do not have divergence, but what we do have is a bullish order block and a buy side insufficiency fair value gap, which means once they fill up these buy orders here, they've done what they needed to do, they filled it up with the candles, they hit onto this bullish order block, and now they're ready to take price going up above the highs, right? Let's do a few more examples. All right, guys. So here was a trade on the 1 hour. Euro USD is what we're looking at. So we're obviously trading throughout, the London session because it's a Euro USD pair, right? So now we do see divergence here. We do see divergence right here going up into the D zone, right? We take all of this away. This was our D zone right here, guys. This was our D zone right here. If we look to the left, what we have is imbalance, right? What we have is imbalance. At the same time, we also do have areas of mitigation, right? But this is all imbalance right here. And so price comes up to that imbalance, right? Comes up to that imbalance, fills it up, and we're also hitting into a mitigation area right here as well. From that point on, price decides to now start falling, taking out lows and imbalances below because we are looking to sell the market, guys. So this is how you could have easily plugged in fair value gap and imbalances with this divergence in the harmonics and with the right price and time, and you would have been able to sell this market. Right? You would have been able to sell this market. If you need a little bit more confirmation, we can go to the 4 hour, right? For the 4 hour, we can see how it looks, right? So here goes D entry, right where that line is at. If we take it all away, here goes our D entry. And if we look to the left, look at what we have right here, a bearish order block on the 4 hour, guys. Bearish order block on the 4 hour, guys. literally on the 4-hour. And so price comes right into it, and we also have a fair value gap right there, right? We have a fair value gap right here in between that market. Go ahead and zoom in, right? So we literally had a fair value gap. Go ahead and take it away. From this wick to this wick right here, just an empty price. There's just a gap in price here that hasn't been filled. There's no rebalancing, right? So if we bring it back, take that bottom from right there to right there, just an empty price, right? And if I was to extend this over, look at what price did. Literally came to fill it to the T and then fall from there, guys. So this is how you can apply institutional knowledge to the harmonic patterns, making them almost 95% accurate, almost to 100% accurate, pretty much, right? Let's go ahead and take another pair. So we're looking at Euro CAD here, right? We're looking at Euro CAD here, and so I don't really see any divergence, right? I don't see any divergence, but what I do see to my left-hand side is that we do have a fair value gap, and we did break below this level. So price left a fair value gap right in here. Notice where price gets into. Price gets into this general location, which is literally the fair value gap, fills it up, and then we fall from there, guys. And we end up falling right from this fair value gap. So it's not coincidental. It's just the fact that there was a gap up there. We filled up the gap, and now we're repricing to go lower, guys. We're repricing to go lower. Let's go ahead and try one on the 4-hour, right? And this can work for any broker, guys. It can work for any broker. For example, if I go to FX Choice and I go to the 4-hour and I do, let's see, NZD-JPY. NZD-JPY was actually a fail, right? But let's see why it was a fail. Let's try to understand why it was a fail and why it did not, hit off of this area right here. Well, first and foremost, guys, we have to understand that right here we had a fair value gap as well, right? So it wasn't truly at a very low point of the market just yet. It wasn't truly at a very low point of the market just yet. We had an order block right here, and we do have an order block right here, right? And so what price did was it said, I'm not going to respect this level because there's still money below. There's still money to collect below, right? And so what did they do? They came down here and they set some equal lows pretty much from the D to X. Now, here goes the importance. You don't see divergence, guys. You don't see divergence. So you wouldn't really want to buy this market because you're not seeing divergence yet. There's a reason for that. They're still aiming for something. When do we see divergence? Right here. Right here, we start seeing divergence. Once they did what they wanted to do, then they started shifting the market. But it took for them to get down here to this order block and fair value gap down here to be able to take this trade. So if we would have taken this trade now, right, or we would have understood why we failed the trade, it would have been from the 50% of this order block, right? And we're going to be using simply a 20 to 30 pip stop loss. So let's say 25, right? Let's go with a 25 pip stop loss. Oops. That's our divergence. This is 50%. Right, 50% of the order block. 25. Let's do like a 30 pip stop, right? Because we still do have money down here, but they shouldn't go below that. So if we would have entered at the 50% of this order block, we would have entered right here, would have been a little bit into drawdown, but ultimately we would have hit our first take profit zone here now for 107 pips, or for where it went up to about 100 pips. You know, you shouldn't always be aiming for 100 pips anyway. So you getting even 50 pips out the market is more than enough, guys. You getting 36 pips out the market, 35 pips out the market is more than enough, right? It's more than enough. But now what we're teaching you how to do is apply these institutional understandings to this knowledge. We wasn't going to buy here simply because we had way too much money down here to pick up, right? And there was also a mitigation area right here. Oops. There's also a mitigation area literally right here. This candle right here, we mitigated price, right? We came down, mitigated price, and it used it again as a reference point to mitigate price and take it on up. Okay, guys? Now, this is how you can apply your mitigations, apply your order blocks, apply your fair value gaps, and then be able to come here and understand why you might want to take a trade and why you might not want to take a trade, right? Because certain times, there might be times where you really don't want to take a trade. So, for example, this right here is very ugly price action to me. I wouldn't even be looking to trade a pair like this, right? This pair, it just looks ugly. Right now, we're just like kind of going sideways. We're not really doing much. So me, I would not have taken this trade. Let's go next to the GBP NZD and let's figure this out. So the entry was up here. We're looking to sell the market. So if we apply some institutional concepts to this, right? Let's go ahead and see what we see to the left first. So automatically I see a bearish order block right here, right? Bearish order block right there automatically. All right, go ahead and change that color. Actually, can you see red? Barely even see it, but this is our bearish order block right there. See, the entry also matches with that bearish order block, right? So, okay, we already have a bearish order block confluence right there with the entry point right there. So now, can we find some type of divergence, something showing us some type of divergence? Well, yes, we can, right? Right here, we can see higher highs, right? We're seeing higher highs being formed, right? From this point to D. But on the RSI, we're seeing lower lows being formed. I mean, lower highs being formed. Right? We're seeing lower highs being formed while the chart is making higher highs. There goes literally multiple confirmations to let us know that, hey guys, we are looking to now sell because there is a lot of imbalance to pick up below. The market shifted. It shifted and started going below. Okay, guys? So this is how you can polish up your skills becoming an institutional trader using the harmonic scanner. Hopefully, with these 3 videos, you will understand how to apply RSI divergence. You will understand the time zones to be trading in. You will understand how to manage your trades and manage your risk. And hopefully, you also understand that by the time the institutional harmonic scanner comes out, you will manually know how to apply this knowledge, which means that you will be ahead of the learning curve, right? Because now you have the actual knowledge manually to be able to look at this market and do exactly what I just did to break down certain trades. And when the institutional scanner does come out, it's going to be doing that for us, right? This is the beauty of this right here. We're learning this knowledge so that you guys can then in return pass it along and allow others to be able to benefit from this knowledge, right? As you guys see, using harmonics, using order blocks, fair value gaps, divergence can create almost pretty much a 99% accuracy in these trades. Maybe 99 is too much, but at least about a 95% chance. It's very accurate, guys. Okay, so let's go with this trade, guys. GBP CAD. This will be our last one. The entry was up here, but notice, remember in the past video when I told you sometimes they won't always get up to the entry zones. Well, let's figure out why. Let's figure out why they didn't get all the way up there. So if we look to our left, we have relatively equal highs right here, guys. We have relatively equal highs right here, but what else do we have? A bearish order block, right? Simply from right here to right here, we have a bearish order block right there, okay? And what I always preach is that you want to take your 50% of that bearish order block, and this could be a very good area where price can come into and then fall from. Well, notice how we have these equal highs, these relatively equal highs right here, right where this order block is. So we're showing that we're rejecting from this level. And then we come right to it one more time. Come right to it one more time, and we fail to go any higher. Now let's see, do we see any type of divergence if that's the case, right? Do we see any type of divergence getting up to here? Well, I see that we have a higher high from here, right? From this area. But now in the RSI, I see that we have a lower high. So yes, we are hitting into a daily bearish order block. Yes, we are trading pretty much above equal highs or creating new equal highs, right? But with the spread, we did trade above equal highs. And we also hit into that bearish order block, and we are creating divergence as well, right? We are creating divergence. So we can comfortably take this sell when the time is right. Okay, guys, and then what we're going to be aiming for if we're selling, the first thing we're going to be aiming for is all of this imbalance that was created right here. Well, we ended up taking that out, right? The second thing we're going to be aiming for would be these equal lows down here, right? Which we ended up taking out, right? Because now we're going to be taking out equal lows and pushing down further, right? Does everybody understand that? If you guys can apply these institutional concepts with the harmonics using divergence and then applying the understanding of equal lows, equal highs, where liquidity lies, right? Fair value gaps, all of these things, they can help you formulate a trade idea that is very solid based off of institutional fundamental analysis and the harmonic scanner giving you an 85 already percent accuracy. All right, guys. So hopefully you guys learned something throughout these 3 videos, and by the time that the harmonic institutional scanner comes out, you guys yourselves will be able to teach many other people how to apply it as well. You guys be safe out there, and I look forward to see you guys' success.